All right, welcome back to the deep dive. You sent over a really interesting set of materials comparing, well, two key players in the AI infrastructure space. Iris Energy, that's IREN, and CoreWeave.
Yeah, it's a great comparison. We're looking at the companies essentially building the foundations, the picks and shovels for this whole generative AI explosion.
Exactly. This is that critical layer for investors, right? Not the flashy AI models themselves, but the raw compute power,
Mhm.
the GPUs, the data centers. And our job today really is to cut through the noise and pull out what matters for you from an investment perspective.
hmm And specifically, we need to get clear on this difference between a pivot play versus a pure play. Because iron comes from Bitcoin mining, leveraging what they already had.
Right.
CoreWeave, though, they're branding themselves as AI native and AI-only hyperscaler. Their origins really shape their whole story, their costs, and frankly, how their stock behaves.
Okay, so let's start with iron, the pivot play. They kicked off in Australia, focused on renewable energy for Bitcoin mining, and hit the NASDAQ U back in 2021.
That's right. So their initial edge wasn't AI at all. It was securing cheap, long-term power. Getting land, building out these big data centers, places like British Columbia, Texas, that was their game,
Power contracts and real estate, essentially.
pretty much. And then, boom, late 2023, early 2024 maybe, the generative AI demand just goes through the roof.
Ah, the pivot point.
Exactly. They realized, hey, wait a minute. This land, this power infrastructure, the cooling we've got set up, we can repurpose this for GPUs. And GPUs are way more profitable per megawatt than Bitcoin miners.
So it was kind of an opportunistic move to unlock more value from the assets they already controlled.
Absolutely. A way to really juice the returns on their existing footprint.
And they didn't waste time. The sources point out they got NVIDIA preferred partner status pretty quickly. They're buying up H100s, H200s, looking ahead to B200s, B300s, even those super dense GB300 NVL72 racks.
Yeah, that NVL72 thing is important.
Okay, unpack that for us. For someone not tracking chip models daily, what's the big deal about securing those NVL72 racks? What does that mean compared to just buying, I don't know, standard servers?
Good question. Because it ties directly into cost and complexity.
hmm
An NVL72 rack isn't just a server. It's like a pre-built, liquid-cooled supercomputer crammed into one cabinet. It's incredibly dense.
Okay.
So for IREN, it means, one, a huge upfront cost. These things are expensive. But two, if they get it running smoothly, they can offer massive computing power in a small space. That means they can charge premium prices for that capacity.
Right. Higher density equals potentially higher revenue per square foot per megawatt.
That's the idea, and they're betting heavily on it.
Yeah, the targets look pretty aggressive. They're talking about, what, nearly 11,000 AI GPUs running by late August 2025.
At 10.9 thousand, yeah. That's it.
And the financial guidance they've put out, they expect AI cloud revenue to hit an annualized run rate of $200 to $250 million by the end of 2025.
It's a bold target. But, we have to keep it in perspective. Look at their current numbers, this two engines idea the sources mentioned.
Right, the mining versus AI.
Yeah. Bitcoin mining is still overwhelmingly dominant today. Like FY25 Q4, total revenue was about $187 million. And $180 million of that, pure Bitcoin mining.
Wow, okay, so AI is still a tiny slice right now. Then why does the stock jump like 15–20% every time they announce buying more AI chips?
Because the market looks ahead. Investors are valuing the potential AI revenue stream that can be built on top of that existing low-cost mining infrastructure.
Oh, okay.
Those AI announcements, buying Blackwell GPUs, for example, they act as signals, as catalysts. It tells the market the pivot is happening, and investors are essentially buying an option on iron, successfully converting those assets to high-value AI workloads.
Okay, so let's zero in on that structural advantage inherited from mining. It's the cheap power, right?
Right.
Those long-term contracts.
That's number one, absolutely. Low-cost power, locked in before everyone else wanted it for AI. Plus, they already know how to find good sites, often with renewable energy access, and how to actually build out these large-scale facilities.
And the scale is significant, 660 megawatts mentioned, between operational and expansion plans.
Exactly. That's the moat. Building new AI data centers from scratch today means facing sky-high costs for power and land. IREN already has a lot of that secured at yesterday's prices, essentially.
So their cost basis for adding AI capacity should be structurally lower.
Should be, yes. That's the core thesis. Look at the specifics, like that 10-megawatt liquid cooling project for the GB300s in Prince George they mentioned.
Right, liquid cooling because these new GPUs run so hot.
Insanely hot. You can't just use fans like the old days. Installing advanced liquid cooling is complex and expensive, but is much more feasible for IREN because the underlying power infrastructure is already there, and crucially, it's low-cost power.
Makes sense. The advantage is clear. But let's talk risks. As an investor, you're looking at a company still making most of its money from Bitcoin. That seems like a big dependency.
It absolutely is. That's the main risk, dual exposure. The stock price is still heavily tied to the price of Bitcoin and how difficult it is to mine. If Bitcoin tanks, IREN's main revenue engine sputters no matter how exciting the AI story looks on paper.
So you're exposed to crypto cycles. What else?
The sheer capital intensity and execution risk,
Hmm.
buying all these cutting-edge GPUs, upgrading power, installing that complex liquid cooling,
Hmm.
it costs a fortune. That's massive CapEx.
Right.
And then there's the execution. Getting those super dense NVL72 racks installed and running perfectly is technically very challenging. Any delays in getting the gear or any problems with the cooling or power delivery once it's running.
Means they could miss those revenue targets they've set out.
Exactly. And if they miss guidance because of operational issues, the market will likely punish the stock pretty hard. It's a high-stakes transition.
Okay, let's shift now to CoreWeave, the contrast. They call themselves an AI-only hyperscaler, mostly US-based. No Bitcoin mining history here.
None at all. Their story is all about AI from day one.
Yeah.
And their big headline strength. It's that massive OpenAI contract.
Yeah, that number jumps out from the sources, up to $11.9 billion over 5 years.
11.9 billion is huge. That gives them incredible demand visibility, just knowing that level of business is potentially coming in. It also lends them enormous credibility in the market.
Okay, so demand certainty is a massive plus. What else?
Performance leadership.
Yeah.
They claim to be among the first deploying the very latest NVIDIA rack scale stuff, like
Yeah.
those GB200s and NVL72s commercially. And they participate in things like MLPerf benchmarks to prove their performance chops.
So they're focused on having the absolute newest, fastest gear available for customers like OpenAI.
That's their positioning.
Yeah.
Leading edge performance, ready to go.
But the sources also flag some potential issues. They IPO'd recently, March 2025, raised $1.5 billion, valued around $23 billion. But there are concerns about debt.
Yes, that's the other side of the pure play coin. To get that cutting-edge hardware first and scale that fast, they've taken on significant debt and lease obligations. It's a highly leveraged model,
So they're financing that rapid growth with borrowing.
heavily. The sources note that a chunk of the IPO money was actually needed just to pay down some of that existing debt.
And the other flag was customer concentration. Obviously, OpenAI is huge, but relying so much on one or maybe a few big customers, that carries risk too, right? I think Microsoft was mentioned as another major relationship in the past.
Definitely. If your business is heavily reliant on a small number of very large customers, any change in those relationships, contract renegotiations, shifts in strategy by the customer, anything can have an outsized impact on your revenue.
So for an investor, with CoreWeave, you get that amazing demand visibility from OpenAI and the performance leadership.
But you take on the risk associated with high debt levels and the fact that a lot hinges on a few key customer relationships staying strong. It's a trade-off compared to IREN's model.
Okay, let's pull it all together, head to head. IREN is leveraging old mining assets' low-cost base. CoreWeave is the pure AI player, highly leveraged, but with that huge OpenAI deal. Why pick the messy hybrid like IREN?
Well, it really boils down to your view on risk and growth drivers. IREN's story is green mining finding a second, more valuable life in AI. It gives them that dual engine.
Diversification.
Right. If the AI market hits a soft patch or competition gets brutal, the Bitcoin mining engine, assuming it's profitable, provides some cushion. And their structural cost advantage on power acts like a hedge against rising operating expenses that pure plays might face.
Okay, so IREN offers a cost moat and some cyclical diversification.
While CoreWeave is all about pure AI infrastructure consolidation, their strength is being first and fastest with the latest tech, attracting those marquee customers who need absolute peak performance now.
Like OpenAI.
Exactly.
Yeah.
Their risk is singular, though. It's all AI. If demand from their big clients wavers, or if managing that debt load becomes difficult, they don't have another engine to fall back on.
Let's revisit those infrastructure strengths again. IREN, legacy cost advantage, cheap power, land, 660 milliW capacity. CoreWeave. Sourcing the latest gear first, performance leadership, proven by benchmarks and big contracts.
Correct. And that difference flows right into their capital structure. IREN funds expansion more cautiously, using vendor financing, cash flow from operations.
A bit more traditional, maybe?
You could say that. CoreWeave uses significant debt and leases its aggressive growth fueled by leverage, betting they can keep utilization high on that super expensive cutting-edge hardware.
So, summarizing the choice for an investor, IREN is the hybrid, repurposing mining assets into AI factories. Pros are the cost structure, maybe
Yeah.
diversification. Cons are the Bitcoin dependency and needing to land those big AI contracts to prove the model at scale.
Yep. And CoreWeave is the pure-play AI hyperscaler. Pros, that massive OpenAI reference customer, being first with the best tech. Cons, heavy debt. Customer concentration risk. It's stability versus velocity almost. Hashtag tag outro.
So, it really highlights this fundamental truth. Getting access to enough high-end GPUs and the power and cooling to run them efficiently. That's the real bottleneck in AI right now. You're choosing between IREN's approach built on a cost advantage from a prior life.
And CoreWeave's approach built on pure performance leadership and demand certainty, albeit with higher financial leverage.
Hmm.
Both are valid plays on the AI infrastructure build-out.
The decision really hinges on how you weigh those different risks and advantages. Do you prefer the diversified model or the focused high-growth play?
Precisely. Where do you see the bigger risk? Is it market volatility, where IREN's diversification might help? Or is it execution and staying ahead technologically, where CoreWeave aims to lead?
Okay, here's a final thought. Something that comes through when you look at the tech they're both investing in, those ultra-high-density GB300 NVL72 systems. This might be the real decider. Both companies are spending huge amounts of capital on this extremely complex, power-hungry, heat-generating hardware. Buying it is one thing, but the ultimate success, the thing that will determine who really wins, it might just come down to pure operational excellence.
You mean execution risk, essentially.
Exactly. Who can actually run these incredibly technical racks flawlessly? Getting the power delivery perfect, the liquid cooling working without a hitch 24/7, the specialized networking humming along.
That's not trivial,
Oh,
especially at scale.
not at all. Any slip up in operations could impact performance, availability, customer reputation, and ultimately revenue. So maybe, beyond the strategy differences, the winner is simply the company that proves technically masterful at operating these next generation AI factories. That operational skill could be the ultimate differentiator.